All right, so we hear a lot about how a very low amount of stocks account for an extreme disproportionate amount of the returns of the S&P over the last year. And a lot of people use that as an argument as to downplay the stock market in general, and even to a larger degree saying like, oh, there's going to be this big crash once these stocks stop performing so well. And honestly, they're partially right, and it is something that's a little bit concerning to me, but I don't think these people are giving you the whole story, because the Pareto principle exists. And I've talked about this before, but I think it definitely deserves a whole video. So again, this is from Brian Feroldi. From 1980 to 2014, a JP Morgan study found 40% of stocks lose money, 64% underperform, 7% accounted for nearly all gains. One reason indexing investing works so well is that all of this chaos is invisible. So that's a very good point. And this is something that, again, I don't think people, a lot of those guys tell you, is, again, at any given point in time, a very small percentage of stocks are going to account for an extreme disproportionate amount of returns. I would bet money that if you take any random decade going back 50, 60 years, probably less than 10% of stocks in the S&P accounted for over half the value, or half the returns, sorry. Maybe even 5%, right? Maybe even less. Honestly, I don't know. I'm just guessing. But I know for sure that it would be an extremely small amount, right? That's something I know pretty much for sure. And again, this is something that is not out of the ordinary. Again, if you have a organization that has 1,000 salespeople, again, a very small percentage of people are going to account for an extreme disproportionate amount of the sales, right? On a hockey team, one guy is probably going to put up as many points as the bottom 5 to 10 combined, right? So again, this is something that is normal in every aspect of society. Now again, I think there's obviously times to where it can be concerning. And again, given that point, let's get into the valuations of some of these stocks and see, are they overvalued? Are they not overvalued? Let's get into it and see. So again, this is Apple. So again, if we look at their valuations, they certainly are a little bit overvalued, right? PE of 30.87, 5-year average is 25.5, price of free cash flow, again, 30.7, 5-year average is 23.28. Again, so they are clearly overvalued. Now again, the one thing that I would point out here also, though, is Apple is probably the most stable of the big tech companies. Again, they're very well established. They have very good. Again, they are slightly cyclical, but again, Apple I think is very good, right? So again, they certainly are overvalued, but I don't think it's anything super crazy by any means. The next one, let's just go over them here. Nvidia certainly is very overvalued. That's one that I definitely would acknowledge. Again, it's actually below its average price of free cash flow and average PE, but we're talking about an average of 75, right? So again, Nvidia, again, a price of sales of 27. Again, I wouldn't be touching Nvidia. If it was like half the price it currently is, that's when I would consider it. And honestly, it'd probably have to go below $200 before I would consider it. Apple, probably about 170 or so. Again, just my opinion there. The next one, Microsoft. Again, they certainly are overvalued again. 5-year average price free cash flow, 33.77. It's currently at 44. The PE, not quite as bad. 5-year average is 30.85. And it's at just over 36. So again, Microsoft also overvalued. Again, they'd probably have to come down about 15 or 20% before I would look into them. If we look at Google, let's check out Google here. Google is actually a little bit below. The PE is almost exactly right on, but the price to free cash flow is actually 18% below. So Google, if anything, is actually a little undervalued where it's at right now. Amazon is very hard to judge because Amazon, I think, defers a lot of their earnings, which makes them look artificially expensive. Again, so Amazon is very hard to judge. So again, I would say Amazon probably roughly fair value. So again, if you look at the big tech stocks on average, they are certainly a little bit overvalued. But is it egregious? Honestly, aside from Nvidia, I would say no. And again, that's just my opinion. Obviously, you really want to do your own due diligence and all that stuff. But again, this is something that I think a lot of people point out, and they think they're making this super insightful point, but in reality, they're really not. Like, they're really not. Now, again, a lot of people say, oh, probably, okay, well, what's your strategy? Do you load up on these stocks? And my answer to that is no, like, absolutely not. I don't do it. But that's because I'm more of a value investor than a growth investor. Now, again, honestly, those are kind of a muddy topic regardless. But you also have to keep in mind that, again, there's a lot of other factors that go into things. The main thing being is I'm a value investor, right? So again, I would say more or less a dividend growth investor. I've said that a lot before. But again, I don't like paying what I think is more than fair value. And another thing too, when it comes to my strategy, is I'm more in it for super long term, right? And when it comes to the bigger companies, they're more of your stability play, right? Because again, if you're buying small caps or even mid caps, the likelihood of them going out of business is a lot more likely than any of these big tech companies, right? So again, that's another aspect that needs to be considered. But a very important point here is there is a lot of nuance in this discussion, like a lot of nuance, and everybody's situation is different. But again, my main point here is just because a very small percentage of companies account for an extreme amount of the returns, it's not a bad thing, because it's not something that should be super concerning unless it's a lot more than normal. And that's something that I would like to see. Is it a lot more than normal? If I was guessing, I'd probably say a little bit more, but I don't think it's probably anything crazy more than average, right? So again, what is my exact strategy is there's two main ETFs that I hold, both of which I've talked about before. Number one is RSP, and again, that is an equal weight index. Number two is the NASDAQ, the QQQs. Why is that? Because why do you not hold the SPY then? That's probably the question that people would ask, or VOO. And the reasoning being is that the NASDAQ over the long run outperforms the SPY or the VOO. So that's my reason for holding the NASDAQ. And the reason for holding RSP is more or less a diversification play. That's honestly the main reason for it. And I think that there's a lot of value in some of those other companies. And again, when you look at RSP, it's got a higher dividend and it's got a higher dividend growth rate, which again is another reason why I like it, because this is like that's ETF is one that you can hold for 20 years and have a 8% yield on cost, right? Maybe it'd take a little bit longer, but it kind of depends on the growth rate. That's my reasoning for that, right? Again, other things, like multiple things can be true at once. You can acknowledge this, but still not load up on an extremely small amount of companies, right? I mean, if you look at Warren Buffett, I mean, he's had times where he's only held like 2 or 3 companies, right? So again, I think diversification is overrated. This is something I definitely do agree with. But again, everybody's situation is a little bit different, and there's going to be times to where you're going to hold more, you're going to hold less. That's just kind of the way things are. But again, I don't think that it's super concerning that a small percentage of companies account for an extremely small percentage of returns. I mean, if you look at these guys, right, the people that point that out, I would venture to guess that they have made several investments in their life that yield virtually no return, if maybe even a negative return, and yet they probably made a very small amount of investments that they really hit it big on, right? Again, disproportionate returns, wouldn't you know it? So that's my point, is if it wasn't for those home runs, well, where would you be? Right? Where would you would be nowhere, right? So again, that's the point there, is that when you look back, again, go talk to any 50, 60, 70-year-old guy who's got a 9, 10 figure net worth. Again, virtually guarantee you that that the vast majority of their returns, the money they made, came from an extremely small amount of times where they really hit it big. Right? And they probably had more times to where they gained nothing or they lost money. Right? So again, this is a normal thing when it comes to life, when it comes to investing, when it comes to everything. Right? So anyway, that's what I wanted to bring up today. If you liked the video, please like, comment, subscribe, all that good stuff, and stay tuned for more.